Well, we want to get you set for the trading day. Joining me right here on set, Barry Knapp, Director of Research, Ironside's Macroeconomics. And so glad you are here. And I know we can have some fun with what the Fed's been doing. So we saw the first cut, first one of the year.
Right.
What were your thoughts about where the Fed's path could be going forward?
I think when the Fed tells you that there's 2 meetings left in the year and the median expectation is for a cut in each of those meetings, pretty confident, unless the data were to turn on a dime, and by data I mean specifically the labor market data,
right,
that they are going to cut twice more in October, in December. I'd like to see them cut again in January. I think 100 basis points to get to 3.25 or so would be a level that would take a lot of the pressure off the small banking system. It would boost return on equity. They'd be earning their cost of capital. They'd be creating credit for real estate developers. A lot of the portfolios that were carrying negatively from all the bonds that they bought in 2021 would stop losing money or carrying negatively. So for me, that's the right level for them to get to, and I'd like to see them get there sooner rather than later.
Look, Stephen Myron, the low dot, on the dot plot, was pushing for 50. Do you think that now he can sort of press some of the other Federal Open Market Committee members to consider 50 going forward?
What I liked about what Myron did was, and this has been one of my, I don't know, pet peeve, is that still a term, right?
Yeah.
But been one of my issues with the Fed throughout the course of this year is we've had dramatic changes to trade policy, immigration policy, government spending, which has been reduced significantly, tax policy has been changed, and no Fed governor has been willing to offer any even qualitative estimates on the impact on the longer-term interest rate, on the rate, potential growth, the rate of inflation. And what Myron did was to say, okay, we're going to cut immigration. That means slower population growth. John Williams, the president of the New York Fed, has been arguing for years that our declining population means that the equilibrium rate of interest is lower and lower inflation. And Myron finally spelled it out. So will some of the other Fed governors take his arguments to heart? They certainly should, because they're sound arguments. So we're not going to his dot, but if we get to 3 quickly, to me, that would be a real positive for the small business sector, which is the part of the economy that is struggling mightily.
So you would like to see more cuts for the rest of the year, the 2, and then January again. What about the yield curve? What's the yield curve telling us, or what are you watching for?
Right. So the 2-10s curve, which is sort of the benchmark curve, right? I had a target of 60 basis points for this year. We hit it. But the problem for the small banking sector is the 2-year note doesn't matter to them. They need deposit rates to come down.
Right.
So they need that policy rate to be cut. When the policy rate was cut a year ago, 100 basis points, they went from a 5.2% return on equity, which is like existential threat, to 7.5 in 1 quarter. Now, 7.5 is still below their cost of capital, roughly 10%.
Right.
Another 100 basis points would boost that return on equity above 10. So instead of just having weak credit growth, not being able to grow their assets, suddenly now they can grow assets, they can buy mortgage-backed securities, they can make loans to real estate developers. So that 100 basis points would be tremendous, but you need to cut the policy rate in order to do that. And so that's what I'm saying. The curve looks steep on that benchmark, but the effective yield curve for banks, small banks in particular, is still flat. And that's a really unusual situation.
All right, so we'll continue to follow that story. I know you're watching the employment churn, the employment picture. That's a big story. And how do you invest in the market? Because are we so concerned about employment that the market comes off? I mean, we did hear Fed Chair Powell yesterday with his irrational exuberance talking about fairly highly valued stock market. What do you think about the market? Is it the employment picture that takes it down, the inflation picture that takes it down, or does it just keep climbing the wall of worry?
My themes for the balance of the year, and next year could be a different situation, but for the balance of the year, with the Fed on track to do at least 75 basis points of rate cuts, unless we get a miraculous recovery in the labor market, which is a very low probability outcome, is that boost to return on equity in the small banking sector will drive small banks. It will drive small caps, which are very interest rate sensitive. And so I think the Russell 2000, the small banking sector are likely to be the two best performing sectors between now and the end of the year. If you consider Russell a sector. I think that could mean a little bit of waning interest in the tech and telecom services theme. Certainly those sectors are far bigger than the Russell, so you can't abandon them. But I do think that the main theme will be this idea that the small business part of the economy is broadening out, and how do you best leverage that? And so I would continue to be underweight anything consumer facing, so staples, consumer discretionary, or healthcare. Even for the next quarter, earnings are expected to be flat with up revenues, so they're getting margin pressures because of tariffs and the tariff
so you're not
tax.
really interested in those.
So I would avoid the consumer-facing sectors. I would be long investment-sensitive sectors as the benefits of the One Big Beautiful Bill Act start to kick in, all the corporate tax incentives, so industrials, materials, maybe even energy. I've let my position in tech start to drift down a little bit. I'm down to 25% tech, which is well below S&P's weighting of that sector. It's still a big weighting, right? I do think that we have not reached the point in terms of capital spending as a percent of cash flow like we were at in 1999 or 2000, or the energy sector was at in 2015, to make a call that, okay, the bubble's going to burst. I don't think we're at that point, but the stocks are pretty tricky here, and we're going to have ebbs and flows. We've had a huge surge in earnings revisions. I would look for them to lose momentum, and those sectors to lag a bit.
You know, it's interesting because, you had the OECD talking about the economic blow from tariffs that they're waiting for, whereas others don't feel that the tariffs cause inflation necessarily, and that they're underestimating what we've been seeing with the tech investments that have been happening. With AI, the boom that continues, you noted. Where do you stand on tariffs, inflation, AI story?
Sure. First, on the tariff inflation, I think generally speaking, Myron is right when he talks about incidence theory. The idea is that China has nowhere else to sell that product. And so since April, the import prices from China have been reported negative each month and then revised sharply lower the subsequent month. They're falling at about a 3.6% annualized rate. So China is absorbing those tariffs because they've got nowhere to go. So they're selling product around the rest of the world. They have, like I said, nowhere to go, right? So their supply is inelastic. We've also cut government spending dramatically, and tariffs have put upward pressure on, or downward pressure on, services consumption. So there's no ability to pass those prices through. So it's not going to be, inflation is always and everywhere a fiscal and monetary phenomenon. In 2021, we had M2 growth at 27%. We had government spending increasing at 45%. Those numbers are now 4.5 and 6.4. So there's no ability to pass prices through. So they are not going to create a higher rate of inflation. They're just highly unlikely to be able to do so. The AI productivity story more broadly is productivity started to accelerate before the pandemic. I viewed the pandemic as an accelerant to that, substituting capital for labor, in the delivery of consumer services. It's getting into the finance sector now. Maybe someday it'll actually contribute to higher productivity in the healthcare sector, which has been a drag on this country for 40 years. AI is probably not really showing up in the productivity statistics yet. You may have seen the MIT study that said 95% of the companies that have invested in AI are getting zero return right now. That number will go down over time. They will find ways to make money on it. But I think a lot of what we're just seeing is the build out of the cloud, companies delivering products via the internet, ordering stuff with iPads, Starbucks getting a third of their customers to skip the line and just pick up their coffee. That stuff is still a tailwind for productivity.
All right. Well, Barry Knapp, great to see you today. Love the energy, love the big picture look. 3 more cuts coming maybe. We'll have to see if they listen to you for January.
Right.
Barry Knapp, Ironsides Macroeconomics. Thank you so much for being with us.